How
But
bad
what I
is it?
could, um, worse than people realize.
Ooh.
And the reason for that is because the only way to mark value to market is to have transactions. And there aren't that many transactions, at least in the open market, in the open trading market. Be it selling properties or things like that, or just general business, right? It takes a while for it to change. But if you want an indication, I mean, just
Mm-hmm.
look at some bonds that are at 2% coupons that are trading at a discount just because SOFR is close to 5.5%. Or whatever other index it's to, is the
Mm-hmm.
3.5, etc. Right? But the point is, just by virtue of that fact, you've taken a loss on your investment just because rates have changed. Now, add to that as a result of rates changing and the cost of borrowing and everything, that the underlying collateral behind those bonds are now worth less.
Welcome to the Rose Show podcast. Welcome to the Rose Show, your ultimate independent source for achieving true wealth. Together, we'll deconstruct money strategies and financial and economic models so you can make better financial decisions that help you make money, keep your money, and enjoy your money. Today, I speak with Shlomo Chopp. He is a commercial real estate vet with over 20 years of commercial real estate experience. He is focused on acquiring distressed, high-quality commercial real estate assets. Today, we talk about what's really going on in the commercial real estate market beyond the headline and news. What's going on with the various uses, as well as the market cycles, and what Shlomo foresees for this cycle in the next 6 to 12 months. It's important for everyone to know what's going on in real estate, even if you aren't an investor in commercial real estate, because it's a multi-trillion-dollar industry. So if anything happens in real estate, you know it affects everyone. Please subscribe to my channel and receive notifications to stay up to date on all the latest. Thank you so much for joining us today. I'm here with Shlomo Chopp. He has over 20 years of experience in commercial real estate. He is founder and managing partner of Terra Strategies, a dynamic investor, high-quality commercial real estate assets. He is also an advisor to borrowers on restructuring. How are you doing today, Shlomo?
I'm doing amazing, Thomas. Thank you so much for having me.
Absolutely. Thank you so much for being here. We're so excited to talk about commercial real estate. It's been a hot topic lately with many people, especially on Twitter. And so we get to have the inside scoop today. And you are in Manhattan, New York City. There is no better place to talk about commercial real estate than where you are. Not too far from me, actually, but I'm so excited. So I want you to tell us about Terra Strategies. It's an amazing company that you built, and you have a great team there. Tell us about your business focus and mission as well.
Well, thank you. So Terra Strategies essentially is a company that acquires distressed properties or really good properties that are priced at distressed levels, but we do it not by traditionally acquiring the properties that are brought to market by a broker necessarily, or even off market, but by actually going behind the scenes and buying either equity positions or debt positions or even security positions, meaning bonds on the market that serve to have these properties as collateral that give us the ability to take bets because the world thinks everything is bad. Then we can go in and buy something that we think is good at a good price and then potentially make a very solid return on that, or actually turn that into property and make a very solid return on that.
I love that. We're always thinking in bets and probabilities. So love to have what you look at. And that's what's really interesting to me, is what to you is a distressed property?
I think a distressed property I would define as a property that is not performing up to its expectations. Now, expectations could be in the form of what a borrower or an owner believes the property should be performing at. It could be that the property is not performing up to a level that allows the lender to get their income from the property. So there's a lot of different metrics, but the end of the day is if your initial plan to buy the property assumed that you were going to make $10 and now it's making $9, it is now distressed relative to that projection. Now, the worse the revenue gets, the more implications there are. So at a certain point, if you don't get all your money, you're okay with it. Okay, I'm not okay, but I'll live with it. If you don't get any of your money, then you're certainly not okay with it. But if your lender doesn't get the money, they're not okay with it, and then they could start the process potentially of foreclosure, etc.
Very nice. Looking for value in distressed commercial real estate. Great. I think it's a great area that you're in. Very exciting times right now that we're living in.
Yes.
So you're also an advisor with Restructuring. Is that correct?
Yes. The advent of very complicated loan structures have made it possible for borrowers to get higher loan amounts at better rates, at better terms without personal guarantees. But the flip side of that is in order to accomplish that, you need to be very creative in where you get your money from as a lender to make those loans. And the more creative you get at getting that money, the more complicated it is to resolve a loan that becomes an issue, because all those people or various parties or various levers and knobs that you pull to make that loan happen now have to be on board or made happy or as happy as they're going to be made in the event there's a problem. So it's not very simply as a borrower calls their bank and says, we have an issue, let's talk, and they have a meeting and they do what they need to do to get to a resolution, but rather the borrower talks to a servicer who then has to deal with bondholders. And then there are documents that articulate if there's a problem in this way, then there's a solution, etc. So there's this translation and these connections that need to be done. And that's something that requires a certain level of expertise to resolve on almost every level. I, since 2010, have been helping borrowers navigate what to tell the lender, how to present it, and how to respond to a lender that comes to the table, understanding what it is that lender needs from that borrower in order to go do their job to reach the best possible solution to a distressed property.
Very nice. You're like the borrower's best friend. It's always necessary to have like an independent third party advising. It's like almost like you're a mediator. You're connecting the two parties, and it's about collaboration and coming together and being creative and thinking different. And you provide that creativity in order to provide solutions. And that's what we want.
I actually think I'm the lender's best friend.
Oh,
Because if you think about it, the lender's trying to deal with the borrower and trying to extract information so that it can make its best decision. I'm able to provide them with that best information. By being the lender's best friend, I could then be the borrower's best friend, because the borrower now understands
so
that the
you're everyone's
lender
best friend.
they just love me. They just absolutely love me. Listen, at the end of the day, I mean, some of these situations, you're like a doctor dealing with a terminal illness because these assets are no longer anything close to what it previously was. So can I really be their best friend? They don't want to see me. It's like tax. It's like your accountant. You don't want to deal with them. You don't want to pay taxes. You think you believe you got to. So when your accountant saves you money or your accountant makes it easier for you, he's your best friend. When he calls you up, he says, hey, I have X amount of dollars to go send to the IRS, then you prefer you would have declined this call.
Absolutely. Well, both parties have a common goal. They want that deal to work out. And so having you there, you're able to smooth things a little bit because, one wants a higher price and wants more money, and the other one wants to pay less. So you got to sort of, get them together to meet on some type of level. And I always say in a settlement, no party is ever truly happy, but that's why you have to settle. right? So it's always like that. So that's awesome. That's a really great, amazing skill to be able to connect those two parties. So you're also a multiple patent holder. Tell us about that.
Well, in 2016, after working on the distress restructuring side for about 6 years, that market changed because properties got better. And I started focusing on acquisitions. And I went out and we're looking at types of assets I should be buying. And two assets jumped out at me as being really a problem. The first one being retail, the second one being industrial. The reason they were a problem is, as an investor, I don't want to buy something that's overpriced. And quite frankly, industrial was is been very hot for a long time as a result of e-commerce, but e-commerce itself is not a profitable business, because not only do you have the thin margins associated with retail, but now you have to ship it and now you have to get people online. It's like you're in a phone book and you got to find the right page to find the right person, and then you got to go and buy the stuff. It's difficult. So while people are really excited about industrial, the reality is that it's, demand is there. Customers want things delivered to the house, but the supply is a really big issue when it comes to profitability. And still, we see until today, consumer companies are having issues, third-party logistic companies having issues. So that was one problem. The second problem I saw is in retail, because on the retail side, you had stores that weren't updating the operations in order to deliver product to the customer via e-commerce, and they were losing traffic, they were losing sales. And you still, even till today, have certain tenants that are just not the types of tenants that you'd call successful, whether it's a JCPenney or a Macy's or a Kohl's. They're just, no one says, oh man, I want to go to the Kohl's. So and with my regrets and apologies to all Kohl's shareholders and executives. So what I came up with is to say, hold on, if we can take the warehouse and put it in a shopping center, then I now could fill vacant space. A. B, I could keep the product closer to the customer, which saves me on shipping. I can also make sure that every store has all products in stock. It's no longer, oh, you like that? We could ship it to your house in 2 days. I came to the shopping center to get it today. On the flip side, if I have all the products in a warehouse, my store could be smaller, which means as a tenant, I could pay less, which also means as a landlord, because I'm doing so much more sales, I could charge more rent. So now the properties actually go up in value. So we now have this new thing called, I called it initially the shopping fulfillment center, where it's all combined in one place and it's local to the customer. I went around and everyone told me to, hey, it's not going to work. Here's why it's not going to work. And they gave me edge case for the edge case for the edge case. And these are some of the smartest people in the industry. I mean, we're talking at the highest of levels, CEOs. I had conversations and was told that I was an idiot, essentially. Not like that. They were nicer about it. So I said, okay, I disagree. I had conviction. Could have been wrong. Turned out I was right. I filed patents. I now have 3 patents. I have others pending. And I am now in the process of bringing that to market. It's going to be a longer process. Being very picky and choosy how we go about it, making sure if we do it, we have the right partners. But essentially, the goal is to have a network of retail fulfillment properties across the country that serve in a larger hub and spoke model, where essentially it does what everyone wants to do now, which is coming close to infringing on my patents, which is fulfill from store and shop in store, and anything online is tied into the store. So provide the customer with a better experience, and provide the customer with better delivery, and provide the store with a better sales per square foot, provide the landlord with more rent per square foot, and so on and so forth. And we got world peace, don't we?
I love it. That's so brilliant. I think it's like a hybrid. And I think that's the way the future is. And I think that's thinking forward and thinking ahead. Well, I'm CEO of a manufacturing company and I okay it. I gotta tell you, I think it's awesome. And
Thank you.
I love that. You're welcome. I love that you didn't take no and you went forward and you continued. You had conviction and you believed in yourself. And I think it's amazing, having a shopping center fulfillment. I mean, wow. I mean, that's, to me, that just makes sense. And, it's
Well, let's not throw a party just yet. I've done Jack, okay? But
it takes time.
they're coming to me. It used to be that I was going to them. Now they're coming
That's how
to
it
me,
starts.
and I take my time. I'm ready when the right opportunity comes to the table. I'm ready. Until then, thank God I make a living, so I don't have to worry about, is this going to work or not going to work. It's there, waiting. We're going to make it happen eventually.
Absolutely. And it's about bringing it closer to the customer. It's all about the customer and the customer's experience. And, the customer is very spoiled nowadays, and then they have instant gratification. So it's very important. I think that's a great idea. I love that. And, warehousing, I have a warehouse and with my manufacturing business, and I always talk about industrial, and I find that a very interesting use. But at some point, like you said, there's lower profit margins, and it's a tough environment. Although there's logistics and you have e-commerce and there's a storage facilities, you have the warehousing. It's definitely a great idea to mix that with the retail, so the customer can pick up the items there or can ship from there. I like that. That's pretty awesome. So what are the markets that you focus on with Terra Strategies? I know you're in New York City. Are there other markets outside of New York?
Yes. We look to buy the best assets in the best locations, and we're generally market agnostic, given that the market can support the saying best location. Right now, there are several across the country that cannot, and we won't touch them. Otherwise, we're open to look at any market. It needs to be dynamic, especially when you get into the various asset classes, right? For example, does anyone need to be in an office in a tertiary market in a suburban edge? I don't think so. Maybe yes, but not to the extent that I'm going to have great leasing velocity, right? So the importance is to be in a market that has great leasing velocity and to be in an asset that could take advantage of that leasing velocity.
Awesome. Well, that's exciting because now we can talk about this. Real estate overall tends to be regional. So it's great. We can talk about the different markets in the States and we can compare them a bit, like New York versus Florida. That's another interesting market to talk about. Yes. Florida, they always think Florida can never get bad. They always think it can only get better down there. So I'd like to know your thoughts about the different markets. I think we'll start with that. Let's talk about the different markets and your take on what's going on in New York City and New York overall in this area, the New York metro area. And let's compare it to Florida and what's going on down there and what you're seeing.
So my thesis on New York versus Florida is really, it's a complicated thing if you think about it. Putting aside the aggressiveness of the average Florida investor for a second. Why would I want to be in Florida? I guess the weather's nicer, right?
Mm-hmm.
But let's fast forward. Yeah, well, yes, taxes. There you go. Okay, but let's rewind a bit. If we look at New York versus Florida, there was nothing going on in Florida. Yeah, there's great nightlife, there's great beaches, there's great weather, there's just a chilled environment. But there really isn't. It's not the insurance capital world. It's not the banking capital world. It's not, insert industry capital of the world. It's not, okay? So why would I want to be there? It comes down to, very simply, taxes, and it comes down to politics, okay? Mm-hmm. And when I say politics, I mean more legislation than politics. And here's the reality of it. 20 years ago, Miami was not Miami is today. Okay. Take a look at Wynwood. I know, like, a friend of mine back then assembled 50 acres in the middle of Wynwood. He had to go run to find a way to build a thing. And he did a great job. He did a beautiful asset here called Midtown Miami, but it wasn't a slam dunk from day one. They had to convince shopping center owners to come in and build a retail piece there. He had to build these huge towers. He had to get the government, I think, some TIF funding to get it done, tax increment financing. The point is, it wasn't what it is today. But how did it turn into what it is today? It's very simple. There's always supply and demand, right? There was demand for people to go to Florida, and there was supply of a lot of people in New York to go down to Florida, but they left because New York is becoming too difficult to do business in. Mm-hmm. It's just, when you talk about multifamily, you talk about, like, just legislation, not talking about what people leave for business, but you're talking about multifamily legislation on rent control, rent stabilization. We're talking about the fact, even when Amazon wanted to locate here, and for all I believe about Amazon, I don't like them as a company, but at the end of the day, you don't chuck out people that want to go in and bring jobs. But that's what they did over here. because Amazon's the bad guy. So we're not going to let them win if we're going to only win partially. We want to win 100%. So when you chase your businesses away, they then find a place to go. It's not that they wanted to go to Florida and said, where am I coming from? They wanted to leave New York. They wanted to leave San Francisco. They wanted to leave Chicago. They wanted to leave wherever they're leaving from. And they picked the place that was opportunistic for them to go to, which ended up being, in this case, Florida, right? So that's an example. So yes, right now, Florida is booming, absolutely booming. New York, it's having its issues. And honestly, New York has got a massive budget to support, and I don't know how they do that moving forward. Property values are going down. People are moving out. Now, I'm not going to say it's a mass exodus, right? But people are moving out. Companies are moving out. It's a well-known fact. So if you're going to enact legislation or put in place policies that make it difficult for business to transact, I don't care your political persuasion, you're going to lose business, because I'll tell you what political party businesses belong to: the money-making party. Whatever that party is, they don't care about anything besides making money. They'll even tell you that your social ideals are exactly what they believe in. And in reality, they don't believe any of it, or they do, who knows? But they'll do it just to be able to generate business, to convince someone to go and buy from them. So at the end of the day, it may not be a popular thing to say, but it's not that people are moving to Florida. It's that people are being chased away, and Florida is a really great option.
Wonderful analysis there. Thank you so much for that, Shlomo. So, I love how you have that insider perspective, and there's so many headlines about commercial real estate. So I want to go under the hood, and I want to really talk about what you're seeing in commercial real estate. And, we're all in the market cycle. We live in cycles. We live in market cycles, economic, business cycles. So right now, where are we in the market cycle with commercial real estate and what you're experiencing?
That's a very tricky question, and I can't answer it because I don't know where the end of the cycle is. The only way to figure out what inning I'm in is to know how many innings there are in the game and to know how bad it's going to get. So the answer is I don't know.
How bad is it?
Worse than people realize.
Ooh.
And the reason for that is because the only way to mark value to market is to have transactions. And there aren't that many transactions, at least in the open market, in the open trading market, be it selling properties or things like that, or just general business, right? It takes a while for it to change. But if you want an indication, I mean, just look at some bonds that are at 2% coupons that are trading at a discount just because SOFR is close to 5.5%. Or whatever other index it's to, is the 3.5, etc. Right? But the point is, just by virtue of that fact, you've taken a loss on your investment just because rates have changed. Now, add to that as a result of rates changing and the cost of borrowing and everything, that the underlying collateral behind those bonds are now worth less. And the reason for that is because when you sell it to the next guy, he's going to buy it based on the cost of his debt. And if his debt to buy it costs more, he could afford to pay only less for the asset. And now let's layer above that in order for him to improve the income on the property, he needs to lease it to somebody. But because their operations cost more, why? Because their line of credit to buy materials costs more, they have less money available for expenses, including rent. So therefore, they are going to pay less rent for the space that they take. And then let's take the next step and say, because they have more expenses and their margins are tighter as a result, they're going to look to cut expenses. And where do they go to cut expenses? To employees. Which means if they're an office user, they're going to take less space because they'll have less employees if they can use it, if the tenant rolls at the time, if it's not a lease. And let's go the next step and say, well, if those employees aren't buying because they are losing their job or their credit card payments are more, or whatever other issue, then the tenant that's a retail tenant, a consumer tenant, they're going to be able to support less of a rent because people aren't buying as much. But this hasn't fully happened yet. We're at the top of the hill with a little snowball. Someone just dropped it. And for some reason, the average person can't see that that snowball is going to grow under normal circumstances. Now, here's the thing. I think it was John Maynard Keynes said that the market could be irrational longer. You could be liquid or whatever the term is. But it may have been him. But the point is, the market is being irrational doesn't mean you could bet against it, because it's possible that halfway through, a laser beam comes down from the sky and evaporates that snowball. And you made a bet it was going to hit the bottom, and I don't care if it's your fault or not your fault or the bet. You are going to lose money on that bet. So, therefore, as a result, it's very hard to bet against it. But if you were to just think about what likely will happen, that's the approach that you take. But as Warren Buffett says, we've gone from, and this I'm paraphrasing his concept, is that the biggest issue we have today in business is that people do not operate businesses for the long-term value of that business, but rather they operate business to cater to investors. Either it's because they want to gain investment in the market, or they want to sell the business to somebody else as a result. So what that means practically, if I have a house and I don't repair the roof and I'm renting it out to somebody, then I show for the last 3 years, I didn't put any money into the roof, and therefore my income is $5,000 a year more. That's all nice and great. But when you look at it, you see that roof is broken, but no one's looking at it. So now he can sell with a better income. The way to operate it for long-term success is to take a little less money today, improve the roof, and not have as big of an issue down the road. So it's really of a question now, as a result of what's your best return on investment over a 5-year horizon or a 10-year horizon, whatever it is. That's the unfortunate reality with solving for capital. So when you have big syndicators and big players going out and buying for what? Acquisition fees, to rope in the dentist that's sitting on $1 million in savings or whatever it is, that is a problem. And that has artificially improved, in their eyes, the value of properties, and has artificially kept property values higher. But over time, there's only a certain amount of income that you could deflect, right? One arrow got it, another arrow. But after a certain time, it's like you're going to get hit. And that's what we're up against right now. And under normal circumstances, that is where we're going to end up. And we'll see. It could change. It cannot happen, but I think it will.
Wow. That was a great walkthrough that you gave us there. So many excellent points. I agree with you. Margins are compressed, and as this higher cost of money keeps working through the system, they're going to get further compressed. And, we have artificially inflated prices. We also, an excellent point you brought up was this short-termism. Everyone's so focused on making that money so fast, and they're not as focused on the long term. And this is definitely a problem. We have high debt as well. So, you said it's bad, and we won't know where we are in the cycle, but we can certainly say that it is a contraction going on. It's unsustainable. Home prices, and I'll just talk about the home prices. We just saw the report came out, still up 1.9% year over year. And home sales are down. I mean, it's just a standstill. There's a mismatch between expectations. Sellers, they want their higher price, and of course it's in their minds, and buyers want to pay less because look at the mortgage rates. I mean, like you said, higher rates cause asset prices to come down, but we haven't been seeing that because not only is the demand is lower, but the supply, there isn't a supply. So tell us what you are doing in this market. If you can share with us what your plans are, how are you handling this, and how bad do you think this really is? We have the headlines, and they're pretty scary. How is it? Is it really that it's really worse?
I don't know if the headlines are that scary. I think the headlines are stories, meaning they talk about specific situations. For example, Brookfield's giving back a office building there, or this guy's being foreclosed on here. But that's individual cases. there's a great saying that I use over and over and over again, and I don't know where it comes from. So whoever came up with it, please forgive me. Statistics never lie, but liars use statistics.
Mhm.
If you want to be told what to do, then you better trust the person telling it to you, because they could spin whatever they want into whatever web that they want to spin it into. The way to see what's going on is to look to motivations. What are they getting out of this? Are they taking the risk alongside me? And what are the bets that they're taking? Are they telling me what I don't want to hear, or only what I do want to hear? And that's really where we stand right now, to be very, very, very blunt. We have a lot of information, but this information is yesterday's news. As a matter of fact, news you'll see today probably happened 3 weeks ago, and then a reporter got wind of it because it finally was a filing. You're behind, and it's only one anecdote. I could tell you, I'm working on, I believe, probably 11 restructuring engagements right now, and none of that stuff has hit the market. And some of that stuff is owned by serious, serious real estate players. But it hasn't hit the market because I don't disclose these things. Of those, I'd say probably 30%, the lender doesn't even have the information yet, because I prepare before I talk to the lender. I don't tell the lender, well, I might have an issue. I'm not sure to what extent it's the issue. I don't know how to quantify it, but theoretically, if I had an issue, would you work with me? And what would you do in that case? And how do we go about it? That's a lot of borrowers like doing. It doesn't work out that way. It doesn't happen. The lender wants to know what the problem is, what the ask is, and we'll decide if we give it to you or not. And we'll decide what our remedies are and take it from there. So the answer is, in order to assess a good market, you need to learn it. You need to understand it. You need to understand the reason for it. In order to assess a bad market, you better be a really good expert, not only on the current market, not only the previous high market and what led to that point, the changes between the two, but also what's happened in the past in other bad markets. Another saying from someone else: if we don't learn from the past, you'll repeat it all, something like that, whatever. So I'm terrible at these. Yeah, I need to have like a little list
You
here.
remember them. That's great. It's a point that you get.
Yes, I get 1 point, but 1 point that's not winning. That's just like checking in, right? So yeah, so there's a lot of these sayings, and they're great to have sayings, right? But in reality, they're true, and they come from experience. Some of my best tweets are as a result of a day of meetings, and I just want to blow off some steam, and I'll make a point that's really great, but it's not because I thought of it and hatched it in my head. It's because I just went through that situation. So yeah, I mean, that's, so these sayings are important. And they, again, you got to see who it came from, right? So at the end of the day, you need to understand the market. You need to understand the dynamics behind the market. You need to be an expert at what you do. There's no such thing as passive income.
Agreed.
There's passive losses, or the absence of passive losses, as far as I'm concerned. You cannot make money being passive. Now, your level of activity could be different, right? Meaning you could be theoretical and hire someone to work for you and then keep an eye on it, okay? But let's be real. As an example, okay? And I have no commentary on this company to share right now. BREIT, which is Blackstone's REIT. There's many people asking for redemptions. If I invested in BREIT, I'm a passive investor. I have zero control. But yet people are asking for redemptions. That's not passive. That's an active request. Okay. So the reality is that shows that if you really want to be a good passive investor, you have to be an active investor. The question is, to what level of activity? You need to know what your strengths are and what activity is good. So for example, if I go on my bike and the chain's not connected and I'm active pedaling, I'm wasting my time. It's not worth the activity. I might as well be passive and sit here and not waste my energy. But if I connect the chains, if I have the connection in my mind and I pedal and I move and I do stuff, that makes sense. So pick your niche, go after it, make sure you know what you're doing, and then make decisions accordingly. But there's no such thing. Hey, I'm a plumber all day. Let me give money to that guy and I'll just wait for the check to come and have it. That doesn't work. You could do the mutual funding. That's great. But do you know who's the lender on so much of this stuff? It's the mutual funds. Do you know, by the way, all these stocks out there that are valued high, and we talk about valuations are too high? I challenge anyone who's in a mutual fund to go and look at the biggest owners of any of these large stocks, S&P 500, any of these guys, it's all the mutual funds. So basically, you're holding the bag. It's you. And you're paying the guy to do it for you. So it's just, there's like, know what you're doing, know what you're investing in. And if you don't have the time and the energy to do it, then put it in treasury bonds, please. Put it in your bank and earn 0.0%. At least you're not risking your principal.
Well said. You sound like my husband now.
Oh my
And he
God.
says the same exact stuff. He's a real estate attorney. So yeah, you have similar mindset. Extended multiples, agree. And there's a difference between action and progress. So, and I always say, and I get into arguments with others when I say real estate is not passive. And they want to always say it's passive income. And I say, no, it's not. It's sliding scale of passivity. You can have more involvement or less, but you need to have some involvement. If your money is invested in a property, you need to have some kind of involvement. It could be minimal, but no such thing as passive income. I agree with you on that.
I'd argue if you don't have active real estate, if you're not active in real estate, you're giving up lots of tax benefits as well. But this is not tax advice, legal advice, investment advice, or anything like that either. But I'm just, think about it.
Great points. Thank you so much for adding that. And I love your tweets. You have great tweets and they come from your experience, from your day to day. And I have tweets that I wrote down that I was going to throw at you. And I love it.
Is that like mean tweets? Is that like mean tweets?
No, they're great tweets. Okay. Here's the first one. When you develop, you are buying the option on demand 2 to 3 years from now. So I want to ask you, what is the market telling us they believe the demand will be in that timeline?
Right now?
Mm-hmm.
Okay. Who's the market? What's the market? You're asking me a question. Ask you to back it up. I need the definitions here.
Let's do New York City.
Okay.
And let's do the use. You could pick the use, whichever you want to talk about. Forget office. We'll do office after about restructuring.
But who's determining the market?
Oh, you pick. How about that? How about you just give us a scenario that's interesting and creative so we can get a sense of where we're going to be in the next 2 to 3 years?
So I just answered your question. And the answer is there is no rule of thumb. I get questions all the time from people. They go like, I want to get into commercial real estate. Is it the right time to get into commercial real estate? Or how do I go about it? I'm like, dude, who do you know that's in commercial real estate? How can they help you? How could they make sure the first couple of years you're not spinning your wheels, losing money, as opposed to actually making money, right? So let's go to the point you asked, right? If I'm developing, I'm buying an option on value tomorrow. So take any asset class. Let's take multifamily, right?
Multifamily, great.
For example, right? And I have a lot at the corner. It's a beautiful lot. And someone comes up to me and says, I own the property. I'm going to sell you the lot for $1 million. And it makes sense. And here's why. Here's why. What does it say there? It says, if you buy it for $1 million, it's going to take X amount of time to entitle it. Let's say it's X amount of time for you to get the zoning approvals. Let's say it takes 6 months, right? If let's say you need to make 10% on your $1 million, you otherwise would be able to invest in a fund for 10%. That means you would have had to have made $50,000 during that time period somewhere else, which means you now are into this deal for $1,050,000. That's 5% based on that 6 months. And let's assume the day after your entitlements, you get your loan, which we know won't happen. We know it'll take a little more time, and you have your approvals and permits and everything. It takes time till you get the property out of the ground, built and constructed. Okay. Let's say that's 2 to 3 years, and that's not ridiculous. People use pro formas of 18 months from the time they get the construction loan, but add some time to the point of buying it, cost overruns and delays and whatever other issues, right? And once you take that construction loan, every dollar you borrow it every month costs you money. So let's say you draw from the bank $10, and let's say you're paying 10%, it just cost you $1 for that year on that $10. So when you bought the land, you said it makes sense because rents are at, I don't know, $1,000 a month per apartment. Let's say that's the thing, right? You're betting, if that's what your pro forma says, that it's going to be $1,000 a month in 24 months from now. Okay. let's look today. If I bought it today, are we headed into recessionary environment, the growth environment? I think the Fed has basically said inflation is high. Now let's understand, what does inflation mean? Inflation means growth. It means things have growth. So basically, the Fed is saying we're growing too quickly. We need to slow it down because other things are not keeping pace with it, etc. So I'm not going to get into Fed 101 and not qualified to do that, but let's put that aside. So the Fed is trying to slow down growth. The Fed's trying to slow down growth. It means the Fed is trying to find a way that $1,000 doesn't increase. Okay, great. We know that when the Fed slows down growth, it basically is causing the market not to have as much demand because the demand has to slow down, which is possible. It means that I think right now that I could get $1,000 a month, but if demand goes down for everything, including apartments, then maybe I can only get 900 at a certain point. Now that's okay if I believe long-term it's good, but I just borrowed for 3 years a mortgage that I need to pay off at the end of the 3 years after construction is over. If I don't have $1,000 a month coming from there, I may not be able to pay off the mortgage. So essentially, and without getting more complex, and I've already made this, there's so many bets you're making and building up to the point, hoping to get the $1,000 a month. And if it doesn't pan out that way, you're stuck. And you just spent all that time, money, and energy potentially to either lose the property to foreclosure, bring in another equity partner that will then dilute your position and have it cost you more, or come out of pocket and essentially cost you more as a result in additional cash flow, additional capital. So the point being is that if I were to buy this property tomorrow and maybe pay a bit more for it, I could lease it up tomorrow. I know what my rents are now. I know what rents are tomorrow. Instead, not only am I taking the risk on construction, which has its own risk. Part of the building says, oh, that crane's not working. That crane's not great. You got to go and reinforce it, stop everything. Or there's some type of issue with materials don't come in. So there's construction risk. And the more time stretches out, the more it costs you in interest. Not only are you taking that risk, you're taking the risk as to where the market will be in the future. So you're basically buying soybean option, futures on soybeans. Maybe you should go into figuring out how to make Nutella and buy soybean futures and know you could make Nutella. I mean, that's a great business. And you may be able to spend less time and energy and still invest with your buddy in some deal in Houston in the meantime, in some apartment building. I mean, why are you betting on commercial real estate futures? Do you really get it? The answer is that some people do, and some people are very smart. But if you think for 1 second that your pro forma is spot on, it's a 2-year lag. I could create a pro forma if I buy a property tomorrow, where I could go. I can make some assumptions saying if tomorrow is okay, then the day after should be okay. But if I then go and build based on construction, I'm taking a much bigger bet as a result, and essentially is almost like commodity futures, which is a very tricky game.
Well said. Time is money. And it's much easier to just turn around and rent that property, as in multifamily case, rather than building, and then you're incurring so many more expenses. And thank you for providing all those different scenarios. Wow, it sounds very daunting. We don't want to be developing anytime soon, it seems.
Well, you wanted a simple answer, but it was like I was either going to
great.
walk right into a, hey, you're wrong because you said that, because whatever. So I was just like, yeah, that's what it is. But listen, there's a lot of people that develop, and that's their business, and they take the risk accordingly, and they benefit from the fees, or they really believe they have an opportunity to really shoot through the pro forma. I'm not going to say that they're wrong. I know for me, I don't like taking such bets in the future personally, but it also depends what you're starting at. Like, for example, if my pro forma is 50% of today's rents, then I'm maybe better with it. I don't know. So yeah, there's a lot of moving parts, and I couldn't tell you for sure, but that's the best answer I could give. You're taking a bet on the future.
Thank you so much. That's exactly right. And there's a lot of uncertainty, especially during these times. We always think we're in the worst times, but I have to say, I think this time is very challenging. So I want to ask you, I know you were around and you were doing commercial real estate back in 2008, 2009, and GFC, and we all know what happened back then. How do you compare this time period? I know it's difficult to compare, but like the same, I'm going to use a quote as well. History doesn't repeat, it rhymes. I don't know who said that either. So I'm not good at naming who said things either. But the point is that, history in some way, the cycles persist. So to you, what you're seeing so far in this real estate market, how does it compare to that time period? If you can do it.
I think it's similar on a high level, but it's different.
Mhm.
And I think in a way, this time around is much easier to see where the distress is coming from to a certain extent. It's similar in that in every cycle, for as long as, for as long as I've been around, I mean, if you just like, if we were to take a quote from something written in 1975, because the magnitude of current industry problems exceed the problem-solving ability of traditional real estate lenders, there's both the need and opportunity for individuals with management skills, capital, and real estate savvy. You know who said that?
That
That is Sam
was
Zell.
Sam Zell, yeah.
Sam Zell in The Grave Dancer. That
Love
was his coming out party. That's where he went out there, said, there's free money being given out. Free money has people doing crazy things with it. And when money is no longer free, and I mean the interest on money is no longer free,
Mhm.
it doesn't cost you money to borrow money, but then when it does, then you have an issue, right? And this happened, this is 1975. And then we had it again in the late 90s. And then we had it again in in the late 2000s, right? And now we have it again. Free money takes risk out of the equation. And as a result, prices go up, values balloon. So what we know is that we had a lot of low cost money. And before it wasn't as low cost, but it was low cost. It was just more readily available. Now it's like 2% rates. I mean, they were very, very cheap rates. So if there are assets that were valued at a certain number at 2% rates, and rates go up, which we know they have, then those asset values go down. It's inversion. Very simple. So right now, we see what's going to happen, and we know that there's a problem. Then we know there's the asset problem above it. We know retail e-commerce is still a problem. I don't care what anyone says. Industrial is a bubble that's going to pop with a resounding pop, okay? And you just look around you, take the small pieces of news. There's lots of news out there. You could see small things, whether it's yellow trucking, whether it's certain logistics companies with CEOs leaving. There's things out there that are problems, okay? And you're seeing these small little pops over time, but that's the demand for industrial. Retail, as the economy declines, retail demand goes down as well. That's an issue as well. Office, we know office. Now, office is not dead. The reason office is not dead is because if I'm a boss, I can't deal with all my employees being in the bedroom. It doesn't work that way. They got to be around here where I can see them. Why? Because as a boss, I'm a control freak. End the story. Let's chalk it up to human psychology. Let's say all the employees will do their job at home. Doesn't make a difference. I'm a control freak and I'm the boss and I pay you, and that's what happens. Find any boss, he has the same ego as I may believe I just had just now, or maybe I do. But the reality is that office is not dead. But crappy office is going to alienate your employees. So you need great office. Now, what does great office mean? To a huge company with a huge budget, it can mean beautiful amenities and just great. To a smaller company, it means maybe great light in here, great ceiling heights, and some amenities. But the cubicle with the low ceilings doesn't work anymore. So a lot of that stuff gets wiped out. So we know there's a challenge with office. Not getting into hospitality, I don't think fundamentally there's as much an issue, other than the fact that a lot of hospitality is based on office demand and some business. So we'll put that aside. Multifamily, other than, I'm not going to get into the supply and demand side of it, because again, that is a whole like statistics have a lot of lies statistics situation with a lot of these commentators. I'm not even going to get into that. What I will say is that they'll finance at very low cap rates and very low interest rates. So the capital stack of those are screwed up, and therefore the debt on that side is the issue, and therefore refinancing debt's the issue, which means it has to go through foreclosure. It has to be revalued, so to speak, and then sent to a new owner. So we have all these, in addition to the interest rate issue, we have all these property issues. So we see where it's coming. We see what's happening. We should see it coming from a mile away.
Absolutely.
But not everyone is acknowledging it. So we'll see. So I believe actually, we don't even have to look to past issues to recognize what's going on, other than the fact to know that every time there's a period of easy money, there's a fall.
Agree. Absolutely. That's how it works. It's the free money and basically negative rates that caused the environment we're in and that caused that banking crisis that, we still have it going on. We're not out of the woods with that. And there's more headwinds coming up ahead. And another concerning part that you mentioned, and I was going to mention as well, was the cap rates. And, cap rates are going to be much lower than the refinancing rates of these multifamily properties. And you want your cap rate to be higher than that. And so that's a big concern over there. And I've been reading a lot about multifamily potential supply coming to the market due to all those foregoing issues. So you're an investor in multifamily as well, in the distressed multifamily, is that correct?
Yes.
Are you looking in that market yet? Are you just being patient and waiting?
We're in that market, and patient and waiting means that we're looking at it and watching it and keeping it under surveillance, right? So we process a lot of data on a daily basis, and that data is being processed as we speak, and we just wait for the opportunity to present itself. So just to, multifamily is one thing, but back to the point you just said before about rates, there's a concept called debt yield. A cap rate essentially is the NOI of the property compared to the property value. And that's something that could change based on finding a buyer, right? But one thing that doesn't change is the cap rate to the lender. That's called the debt yield. That means the NOI of the property divided by the debt balance. And if the debt yields are less than interest rates, forget about meaning index rates, meaning the treasuries. And right, if you have a debt yield at 4%, I won't be able to refinance without coming out of pocket for cash. And this whole concept that people have dry powder, I love people saying, I need to deploy. I got dry powder to deploy. Oh, really? Hi, Mr. BlackRock. Nice to meet you. How you doing? But it's like, dude, you got some money. You want to invest some money. That's very nice to hear. Okay, you want to be fancy about it. Great. Okay, what's next? You have some dry powder to deploy. Or better yet, let's talk about the BlackRocks, the Blackstones. They got all this money to deploy. Where do you think it comes from? It comes from a lot of people, a lot of institutions that get it from a lot of people. Let's trace back Blackstone's money for a second, okay? Who invests with Blackstone? Who invests with BlackRock? Who invests with Starwood? Who invests with all these guys? Insurance funds, pension funds. Where do they get the money from? Well, insurance funds get it from insurance companies, get it from the premiums that you and I both pay on our insurance policies, and they go invest it so like that they can make a return, and they make a bet that the amount of money they're going to get every month back on the return is going to be enough to pay whatever claims they have. Or even a pension fund, same thing. They pay out every month the pension, same bet, right? So essentially, it's you and I, okay, that are investing through a bunch of people that are making money to make this great investment in these large institutions, and they're making bets. Well, when property values go down, they suffer, right? So at the end of the day, when you have debt yields that are less than interest rates, that means that you're saying that U.S. Treasuries are riskier than the property. No, I don't think that's going to happen. I think the property is riskier than U.S. Treasuries, given all the things we discussed, which means you won't be able to refinance, which means there's going to be distress, which means there's going to be foreclosures, which means there's going to be sales, which means when you sell it, new buyers like, oh, I'm going to buy that. That's a problem. I'm going to give you a lower offer. And that's how it starts. And that's how the issues are. So yeah, I think it's a massive issue. And I can tell you, I'm underwriting entire CMBS trust where I have a 100% default rate absent the owner putting in money upon maturity.
Wow. That's right there. Says a lot. So, okay. So multifamily, you said that industrial, you mentioned, and thank you so much for that, by the way. So industrial, your opinion is that that's in a bubble. I agree. I think they were selling at a high premium. So what do you foresee in that space with what's going on with e-commerce and warehousing and the whole industrial space?
It's hard to tell. I know what I believe is going to happen based on common sense, but we go back to the whole rational and liquidity thing, right? Because I would have bet on the bubble popping a long time ago, to be very frank with you. So, I don't like timing bets. I don't like macro bets. I like betting on specific assets, right? But yeah, I think there's going to be massive challenges. I think we're already seeing a decline in demand. We're seeing a decline in rental rates. And industrial is going to be having issues moving forward. whether it ends up popping as a bubble, ends up deflating somewhat and then recovering somewhat, I don't know. It's really, really hard to tell. And there'll be people in Dallas and, Texas say, oh, what are you talking about? We have a great market over here, right? But NAFTA, blah, blah, blah. You have guys, talking about how, Vegas is becoming a hub. Ohio is a great hub because it's surround, great distribution hub. Kentucky, different markets. Everyone will say the little micro thing. And yes, micro, you can make money. If you have a great warehouse in a market with a lot of demand, you say to yourself, even if demand declines somewhat, I have the best warehouse in the best market. Okay, great, it's possible. But as a general rule, rising tide raises everything, receding tide recedes everything. And to get another Buffett quote, that when the tide goes out, he sees with swimming naked all along.
Absolutely agree. Now let's talk about retail. What are you seeing in the retail space? And you can include mixed use. A lot of New York has the retail downstairs, and then you have, multifamily upstairs. We can throw in mixed use in that, or you can separate it if you prefer.
So I think retail is interesting because retail was looked at as a very tough asset. And retail was facing a lot of headwinds competing with e-commerce, and people weren't going to the store. Over time, that sort of, balanced itself out a bit. And because retail was looked at as in a very negative way, now retail is actually considered a darling, and people are investing in retail. But it's back to the old tricks of like, oh yeah, that's a great long-term lease with a great company, Macy's or whatever. And I don't see it long-term as that attitude making sense. But I do believe retail long-term is going to be okay, notwithstanding the fact that when the market declines and people spend less, then sales go down, and rent goes down, and the natural issues. But that would be just a recessionary cycle and nothing extraordinary, such as we're dealing with office or even multifamily with the refinancing issues and the cash flow issues. So long term, I'm bullish retail as an asset class, but still understand that there's going to be a dip. And retail is the one where location really matters, right? Residential, you could drop a house anywhere. You could drop a house at North Palm, provided you have the right heating, you're good to go. Hotel, it has to be, near a place where people live. It could be near an airport, depending on what you want, but you could get to it. You could travel this. It's not a big deal. Retail is really for traffic, right? That's what it is. And so if you could buy the right assets in the right locations, then you could do very well. Notwithstanding the fact that you may take lumps of it. So you just got to really microanalyze every single one you have.
Well, at least there's a positive in there. So retail has some positivity to it. And then mixed use. Are you a fan of mixed use properties because of the diverse mix of uses?
Yeah, I think the future of real estate is mixed uses. I don't think, we've become sort of a startup society where there's a lot of flow through from industrial. Like even you think about e-commerce and retail, right? That's industrial and retail, right? Industrial is the outskirts of town, and retail is right in the best area. And if you were to think about this combination of retail and logistics, which I think is the inevitable future, just from personal opinion, then that is mixed use, right? Residential upstairs or retail downstairs is mixed use. Office with residential, yes, because people don't want to travel that much. That's why I think we're going to see somewhat of a resurgence in certain areas in suburban office as a result, because people want to be near residential. I think the work live play of office, residential, and retail is also a blend. I think the hospitality has always been a blend when it comes to office, when it comes to residential. There's been hotel condos. So mixed use is the oldest thing in the book. So I think that continues to work, and it continues to be a viable solution moving forward. So yes, that's the community is comprised of various different things. If you have your own micro community within a community, it's still the same thing.
Yeah, it's always been my favorite asset class of all the commercial real estate. And I was actually looking at a property a few years ago near us here, and it had the retail with the warehouse in the back. And we were interested because of our business. But yeah, there are a lot of our customers for our manufacturing business. They produce a product, but they're light manufacturing. They're not anything too industrial. So they like having a warehouse in the back, and then they have their retail storefront, which makes sense. And then they have office upstairs, some of them. So they have a blend, or they can have multifamily upstairs. But I love the mixed use, the diversity of having, different uses in one building. That's always been exciting for me. So now we're going to go into office. I agree. Office is not dead. And there's restructuring, reallocation. There's always going to be a way. You just got to think different. Challenges bring opportunities. And you had a great quote that you have from Zell. And I think that was on your website as well. And I saw that on your website, when problems exceed, and I like to say when they vary outside the basic traditional standard way of thinking of things, it's a need for creativity, creative terms, creative thinking and deals. So with that in mind, what are you seeing going on in the office space, and how are they restructuring there?
I think, okay, so with increased supply or less demand, and the combination of both, tenants could be pickier with regards to which spaces they take. So naturally, they can take the better spaces. The term better spaces really depends, right? So every tenant would love to have the best space. Heck, I'd love to have the fanciest car, but if it just doesn't work in the budget, it doesn't work. So, I may not get that yacht today, and the tenant may not get the 5-star office space, but he's going to want it. And to the extent anything close to that's available, he's going to take it, which means we're going to see this. We're seeing this bifurcation. We have class B minus, class C. That's dead. That's over. Those are, I don't want to say knockdowns, but knockdowns. Okay. Well, I just did. And so you have this bifurcation, and tenants can demand more, and landlords have to give more. But there's a problem. The problem is that the landlord still has to pay their mortgage, which is based on yesterday's concept of office, that if you have office, someone will lease it. No, it'll be for less, but still, office demand was 80% or 90%. It's not going to drop down to 65. Well, here we are. It's at 65. So what are you going to do? Well, that's when it needs to cycle through. People have losses. People are taking losses. Even the best of office buildings are going to take losses because they got to pay more for the same rent, or maybe sometimes a little more rent, but they have to pay more. TI's high. Tenant improvements, leasing commissions are, well, again, tenant improvements, leasing commissions will be what they are as a percent of the rent. But tenant improvements, incentives, free rent, and rent could be lower, although in some cases, the best of properties, rent is still rising. Because at the end of the day, if you're going to put a lot of money into a property, it's going to cost you, and it doesn't make sense to do it unless the tenant's going to give you a long-term commitment in return, because you want to be able to amortize it across that lease. So essentially, the answer is we got a bifurcation, and the best of offices do well. The worst of offices will die, won't exist. And then in between, the question is, how do you make the best of what you have? And I think the future is the lifestyle component, where you can actually provide an office that's desirable to the tenant to come into, desirable to the tenant's employees to come into, that the tenant can bring employees in, have them be excited enough to attend there. And I don't necessarily think that it's that you give kombucha. that's not the answer to all, but things close to being inviting, I think, is important. So those that are able to provide that will be great. Those that can't, won't. So if I have a 9-foot ceiling, drop ceiling, not great light and air, you're dead.
No. It's about supply and demand. And it's very disconcerting about, it is what it is. COVID changed the way we work and the way we live. And now there's just going to have to be a restructuring, and it will work out. But like you said, some of those B minus, who wants those, right? They're going to have to be torn down and then rebuilt even better. And that's what I like to say. They're going to come back even better. And it's going to be better for all, and for the customer, and for all of us as a society. And that's how we have to see, and we have to be positive about that. But it seems to me that things most likely will get worse before they get better. Would you agree?
Yeah, I agree. And one point on something you just said with regards to it will work out. Well, we're investors. Individually, every one of us has exposure in some way. Our investors, we're not the actual buildings, so the buildings will be fine. They'll be fine if they're vacant.
Exactly.
They'll be fine if they're occupied. It's not, but that's irrelevant. Question is, will your investment work out?
Mm-hmm.
And likely the answer is no. So that's the real challenge. So I think there's going to be challenges moving forward, and I think it's going to get worse before it gets better.
Well, we'll be prepared for that. And, I want to go into, thank you so much for that as well. I want to go into some of your metrics that you use and how to gauge the current financial analysis and future potential of properties. Like, what are some things you look for as an expert in distressed properties?
Cost of operations. If it cost me $30 a foot to operate, I know I'd even make at least $31 a foot at 100% occupancy in order to make a profit. I mean, that's the key thing. I know if rent drops 20%, it could be that my property is now worth nothing on a cap rate basis. Could I carry it? Right? Those are things that are extremely important. Cost of operations out of occupancy. What's realistic on a lease up? You cannot do this without a discounted cash flow. You can't. So I think that's extremely important to sort of get a sense of it, right? Demand, what tenants could pay. Sometimes it's easy to figure out, sometimes it's not. For example, if you assume that a tenant could do $300 a foot in sales in a retail shopping center, and you figure that 8 to 12% of sales, and you know where the rent could come in, and then you could figure out a pro forma on it. Office is a little more difficult to figure out. It's more a question of supply and demand, and it's a question of how quickly could I get leases in place before the supply increases and therefore rents go down, or what's the number at which no one's going to rent anyway, so there's a floor on where those rents are going to be. So there's a lot of moving parts. There's no one specific thing, but the macro analysis of X per foot or everything's worth something, not a real big fan of that approach.
Thank you so much for that, for sharing that. I mean, you're certainly an expert in that. And, you have an ability to see the potential. And that's a special skill that takes years of experience to be able to see that potential and have a feel. It's almost like I call it expertise-based intuitive decision-making. You can just feel it. You just know it. And that happens in real estate, is that you can just get a sense of that market and you can know if it's a deal you want to move forward or not. So thank you for sharing that.
No, usually I try to only use that in the negative. If a deal looks perfect, but there's something missing, it's like, no. But
Too good
if
to
it just
be
goes
true.
positive. Yeah, because if you think of it the other way from a positivity perspective,
Mhm.
you're gonna get suckered into deals because you like something about it that you just can't identify and you can overpay. So you have to use it as a guardrail. It's the same thing with comps. Comps are good to tell you if you overestimated. They're not always great to say if you underestimated, because the assets may not be comparable. But if you have a great asset and you're projecting $20 a foot and the market comp says $30 a foot, and you know that your asset is the top of the market, and you're low. So that's really where you could use comps. And you could also, if you project the $30 a foot and you're not the best asset in the market, then you could look at that as a guardrail, but you can't make a determination based on that. And the gut-based decision making is what helps you to fill in the cracks, so to speak, but it can't make a determination on the deal, at least in my opinion.
I like that. You use it to walk away from deals. And that's another important point. I think we tweeted about it recently, is it's important to walk away, reserve that right to always walk away if something doesn't seem right. And that's a key part of that. Now, I know you're also a chief negotiator, and real estate deals are about negotiation, and you're also an advisor. So I know it can be more of an art than a science. And so there's a lot of different key points. I think it's important, like we said, to be able to walk away, remain non-emotional, don't act impulsively. And, they always say, don't mention the price first. The one who mentions the number first usually loses. What are some top negotiation points that you've learned over the years that you find essential in making a good deal?
The most important one is an ain't over till it's over. Deal could happen last second. If you're the one that wills it to happen, then it's an issue. I don't think there's a problem with throwing out the first number. I think there's a problem with throwing out your best number first. Yeah, I think there's a problem.
Mm-hmm.
But but a negotiation could last. And just because the other person isn't coming to the table doesn't mean they're not interested. And actually, they could want you to believe they're not interested. But the reality is you need to understand their motivations, their moving parts, and where they ultimately want to get. And more than that, you need to understand where you want to get. What do you want to get out of this negotiation? Like, and if you're not willing to walk away, if you don't get what you want to get, that means you want to get less. That means you're okay getting less. And if you are willing to walk away, then you got to stick to your guns. And quite frankly, you can lose sleep over it all you want. And trust me, I've lost sleep over many negotiations and still do, and toss and turn. And, but at the end of the day, it's either going to happen or it's not. And you need to be prepared that if it doesn't happen, what do you do next? Because if you close fast-footed, then the loss of that negotiation will be the loss of much more. So I think it's like, as long as you keep yourself as disciplined as possible, it's impossible. We're human beings. We have emotions, right? We get emotional, right? But if you know where you're headed, if you know where you want to get, that's great. And sometimes you don't need to know where you're getting. Sometimes you could be like, hey, I'm going to start at this negotiation to see where I can get with the other guy. And I'm just telling everyone how to negotiate with me. Great. Thank you so much. I appreciate it. But the point is like I may start at negotiation and say, okay, I don't know what this guy is thinking. I don't know where he wants to get to. Let me throw something out here and see what happens. See what he does with it.
Yeah.
Right? Let me throw something. Oh, he just said that. I thought it was A. Now it seems like it may be B. But let me do a total mind, and say, okay, what if he's saying B to get me to do A? And what's the variables? It's crazy. After a certain time, you'll feel it, you'll get it. And then you have to relearn it every time you negotiate with somebody else. So it's not something you can learn out of a book. But I do think, nonetheless, if you could study negotiation, I've read many negotiation books, not for the reason to tell me how to negotiate, but to hear how other people think about negotiating, right? Just like, some people like never be the one to propose splitting the baby, or never be the one to propose this, or always do this, always. It's like, okay, that's how people are thinking. That's great. How do I think? And the reality is, if you ask me to write it down now, I couldn't tell you, but I could tell you these little tidbits. And, negotiation is difficult. To come and say, hey, I'm offering you $1. He goes, I want 10. I'll offer you 7. I'll offer you 5. The guy says, no, I want 9. I'll offer you 7. Okay, you got a deal. So that's not negotiation. That's just like, okay, let's make the negotiating. You got this. I got this. Okay, go on. Have a good day. 5 seconds. That's not negotiation. That's nothing. You just had a conversation. It's done. What if you are drowning and the guy says, I'll save you. I want $100. You go, no, I'll give you 50. So you know what? I want $200. Whoa, you wanted 100. Now you want 200? Well, you're negotiating with me. You're about to die. I don't care what's going on. Okay, I'll give you the 100. No, 150. And it's coming. That's negotiation. That's where be careful what you do, because everything is in balance. You're not negotiating good faith. It's not a good faith. You're about to die. Good faith to you, right? So that's the key thing, right? But then on the flip side, the other point that makes for people is that you need to be able to allow the other person to reach a deal with you as well. You can't throw them in loops so he just gets totally frustrated, because as much as you believe, or I believe, or somebody believes that negotiation is this art, this science, or whatever it is, that you have your thought process about it, doesn't mean that person has a thought process. So, for example, if I sit down with you and I talk about whether E equals MC squared, it doesn't equal MC squared. All I know is whether E equals MC squared or not. I don't even know what the implications of those are. And if you know, that's great. But if you try negotiating with me as if I know it, I'll set off a nuclear bomb somewhere, and and it's not going to be my fault because I didn't even know what I was dealing with, right? So at the end of the day, you need to also understand where the other person is coming from and what its limitations are and what the risks are in this negotiation. So that's what I would tell people. But it also takes the personality. It takes the ability to be hardened, the ability to live with defeat. If you get defeated, and also be able to fight the next day, right? We all fail over and over and over again. So
love it.
Yeah, I could go on and on with all these different things, but yeah, that's those are some ideas.
I love it. It's so true. And it's about connection, understanding the other person. And no two negotiations are ever really the same. It's about making that connection, understanding. And there's just so many complex parts to it. And like you said, you have to sort of be understanding of each other. And like if one person understands something and the other doesn't, you're not really able, you have to know that about the other person. Excellent points there. I love it.
Yeah,
And
but
then,
I want to. I just
yeah,
want to point one thing you just said, if you don't mind. I'm sorry for
sure,
interrupting.
please do. I want you to.
So you just said you need to understand the other person. 99% of the world thought potentially thought, absent what we discussed back and forth. Now, they just heard that clip. They think like into negotiation, be nice to the other person, understand the other person.
No.
No, the answer is negotiation is a manipulation. Just deal with it, guys. If you
Mm-hmm.
can't deal with negotiation, manipulation, don't negotiate, right? If you don't want to manipulate people, then have someone else do it for you, or live under a rock.
You have to
Because when you
know.
negotiate,
Mm-hmm.
when you get your life insurance policy, your car insurance policy, somebody negotiated with somebody to get to that number, right? So that's what it is. It's transactional. In order to transact, you need to know what the other guy's going to give you. You need to get him to the point.
Yes.
You're not going to be able to, unless you put a gun to his head, you won't be able to do something. And if he doesn't have what you want from him, you can put a gun to his head and all he wants. He won't be able to deliver it to you. That's why if you take, for example, torture, right? Torture when you negotiate, when you deal with hostages. I mean, if the guy, he'll lie to you. You won't get what you want, right? So the reality is understanding the other party is about understanding what they could give you
Yes.
and then working with that.
Yes, exactly. Yeah, it's not about being nice because that's not negotiation. In negotiation, you want to win and you have to be ruthless and you have to, of course, you have to have tact, but it's important to try to figure out what the other person's thinking. And because they're not going to tell you. And otherwise,
Yeah.
if they do, they're a very poor negotiator, but they're going to use that as leverage against you. And so you have to try to like read them. And so that's exactly right. Now, I think of that song by, I think, Kenny Rogers, The Gambler. And you got to know when to hold them, when to fold them, when to walk away. But I also think about you don't count your points when you're sitting at the table. And that's exactly what you said. That was your first point that you made. And that's it ain't over until it's over. So you don't start counting your money, right? When you're in the middle of the deal because it's not done yet. So
Yeah.
excellent points,
That
right?
song, that
Uh-huh.
song is my second favorite Kenny Rogers song.
Ah, what's your favorite?
The Greatest. I think it's
Oh, I
called The
love
Greatest. Kenny
that.
Rogers, The Greatest. You know the song? I
Yeah,
think it's called The Greatest. Is it?
or something.
I'm seeing Googling here.
Okay,
Hold
you look
on.
it up. I think
I
it
gotta
sounds
tell you
familiar.
because yeah. So basically, it's about this kid, and this is the story of anybody in business. This is the greatest
Mhm.
song about this kid that goes out with his glove and bat, and he goes and he says, "I'm the greatest hitter," and he tosses up the ball, boom, misses. Strike one. Throws up again. Strike two. Throws up again. Strike three. He goes, man, I thought I was the greatest hitter, but in reality, I'm also the greatest pitcher of all time. And that's when you're a startup, like, or you're in business. Sometimes your success comes from places you didn't see. And sometimes you need to tell yourself, hey, this is going to be good. This is okay. I just figured out an angle. And sometimes you got to pump yourself up because someone else is going to be able to do it. So that in my mind, like when I heard that song, I was like, this is me, right? This is me. And this is like everything I've done. Like you have to figure it out on your own, and you could get help from people, but at the end of the day, you need to do it. And sometimes you just got to pump yourself up and do what it is. So that's why in my mind,
I love it.
that's his best song. And one of my favorite songs of all time. But no one to hold him, no one to fold him is the negotiation thing. And you don't count your chips at the table. That's for sure. It's bad. It's bad form. And it also, you're maybe counting it too early. When you get up and cash it in, then we'll talk. Right. So, or when you're at the table and you're there with your wife and your wife takes the money and puts it in her pockets and you can't play with that anymore. And you can count what she has in her pocket.
So funny. Excellent points there. It's about mindset, and you have to be your greatest supporter. You have to support yourself, and it's about picking yourself up after you make mistakes because you're always going to make mistakes. It's about picking yourself up and coming back stronger. And that's key in business, in real estate, in deals, negotiation, and trading, and everything. And to be successful in life, I know it's a subjective term, success, but to accomplish your goals, to move forward, to have progress, you need to learn from your mistakes. And then there's some people that say it's an educational experience, and it hurts to be wrong. You don't want to be wrong, and that's why you have confirmation bias as well, because you don't like to accept that you're wrong. But sometimes accepting it, dealing with it, feeling the emotions, and then moving on, and then always make your decisions not based on that, the impulsiveness. So excellent points there. Thank you so much. You had another great tweet, and I'm going to have to bring up this tweet. It's about WeWork.
Okay.
And you brought it up. I think you tweeted it today or yesterday, but it actually hit home with me because I was in negotiation with the franchise and commercial real estate, and it was a similar situation. So I want to walk through it for everyone. Excellent. I think everyone should follow you on Twitter. And we'll go over, I'm going to put that in the description to follow you because you have some wise words that you tweet. You have WeWork situation. You had part one. The WeWork goes to the landlord and makes an offer to get some concessions, a small buyout for termination, a blend, reduced rents, so forth. And then they use leverage. They say, oh, I'm going to go bankrupt. I'm sorry if I don't get this 100% correct as your tweet, but I'm going to go bankrupt if you don't accept. Some landlords accept. Other ones say, take it, shove it. I think that's what you had written in there. You can shove it, right? Part two, they fold. The WeWork files bankruptcy, forced liquidation because the landlord was unwilling to help out and they don't want to have zombies there anyways. Okay, so with that scenario, you gave us what you think how it's going to play out. So tell us what you would do. What do you think the best case scenario is in that situation? It seems that collaboration, correct?
I would take whatever money I can and let them go. Because I don't think I'm going to see another penny from them as operator. Here's the reality. WeWork is a flawed operation. Sam's all the greatest line about WeWork. They're trading short-term liquidity for long-term liabilities. Essentially, they have people that pay the month-to-month rents for long-term leases that they're paying. But there's even a worse problem. The problem is that they're essentially saying that there is a big difference between the rent that a landlord could get and the rent that a tenant pays, and that a tenant currently pays because of this operation that the tenant otherwise has to put in place. If you put operation in place for them, then the tenant will pay more than there's profitability over there. And I personally don't think that's the issue. That makes sense because I think markets eventually are very efficient and they pull out the last dollar. And quite frankly, WeWork's not giving the landlord anything they otherwise can't do on their own. So I don't think WeWork as a business is great. And quite frankly, the Regises of the world and guys like that, I don't think as a business it's great. And listen, it's possible you could have a specific location you could lease. Where you could rent from a company and then sub out him for certain startup companies, but to a certain extent, doesn't go beyond a certain number. And especially sometimes the rents they charge are pretty high relative to what you're getting in return. It's very blah, very vanilla, and it's not honestly, in my opinion, inviting. So I don't like the business. I think the business is flawed. I think the business is going under. So if the business is going under, if I renegotiate their lease in some way, or if I tell them to go jump in a lake, I'll see nothing. But if they're offering me money, I'm going to take the money.
I love that.
Now, the one thing I think you got to consider is that sometimes in bankruptcy and I don't know if it's possible in this situation, is that a judge could say, well, that money shouldn't have been spent on whatever it was spent for. It was too close to bankruptcy and it was a last-ditch effort. So therefore, we're commanding that you give us back the money. And as a landlord, if I took that money, I might have to go back. So I may want to put it aside and wait. But the reality is, take the money. And I think that WeWork is now like, at the end of the day, so I'll give you an example, right? Let's think about Sears, right? Sears at the end started selling off pieces, self-cannibalization, right? Because at the end, you're like, okay, what can I do to save something? That's what it is, right? It's not self-cannibalization over here, but it's a last-ditch effort. And we know it's a last-ditch effort because they already said we're not viable as a going concern. So if they're trying to get something out of you and they're ready to pay you for it, take the
money. Love that. I like to say it's like take the small loss now rather than take the big loss later. And, it's, you got to have foresight and it takes experience like you speak of, you have that experience, how it works. And having dealt with this as well, it's like the landlord has to just take the money and run. You can say it that way. If you see a business that's potentially failing, and they're offering you some money, it makes sense to just take it instead of holding out and expecting and just being greedy in the moment and just saying, no, I don't want to take this loss. It's about seeing the big picture. So
Yeah.
excellent point. I love that scenario that you threw out there for everyone to think about. Very important there. So I see you also do property management. I find that a very challenging area in commercial real estate. Whenever we did our commercial real estate, we always had another company, another party doing the management. So could you tell us some successful tips how you run your property management? Let's say multifamily. I saw you have some huge multifamily, I think something in Brooklyn. How do you run that division?
So I don't actually run that division as it's part of an affiliate that we have. So I'm really not directly involved in it, but I could talk about some of that if you'd like.
Sure,
So
that'd be great.
multifamily property management in Brooklyn is extremely difficult, given
Oh,
especially the
yes.
regulations that you have locally. I think it's a delicate balance between providing services and providing a place that people can live and not spending too much. And just being a responsible landlord, I think what it is. I think you have responsibility to your tenants. I think the tenants will be ultimately required to pay whatever you ask them to pay. They have no choice because that's what the market is. So but property management, on the other hand, is where deals go to die, because if you're not properly managing the property, you're not going to get the cash flow from the property, and
Yes.
it's going to be a real challenge. So it's blocking and tackling, right? At the end of the day, if you think about it as a football game, and I know everybody loves thinking about things in terms of sports, at least the guys do. And if you think about it as blocking and tackling, if you can't block your quarterback, then you're not going to get a touchdown. You're not going to get even, you can't block your running back. You're not going to get past the line of scrimmage. So, and these are not glorious places where you have, guys pushing and blocking as opposed to the guy running down the field and catching the beautiful catch. So while the refinancing guy is all very happy making his beautiful, good $20 million refinance, it's because the guy that every day is taking care of repairing the toilets, he's the one that's basically making sure that things are done properly. He's the one that's making sure that there's actually preventative maintenance being handled. And then the question is, how do you balance it properly? How do you get it done? How do you have the proper relations with the community so that you constantly lease up the space? So those are issues that need to be dealt with, and those are issues that need to be handled. And the same thing goes to all the other asset classes. I mean, tenant relations at the end of the day is the key part of making money. Tenants pay you the money, they're your customers. And to paraphrase a friend of mine who works for a very large REIT, who said very simply, we unfortunately end up in a situation where we sign a lease with a tenant and we don't talk to them until the lease comes due. When in reality, you should be visiting them every once in a while. Not to say, I heard you have a problem, but rather to say, how can we help you? What's the issue? Are there any other issues, any problems you have? Because the small problem that you may say, don't wake him up. Let him, shouldn't bother us. Okay. But when it becomes the issue to bother you? So better that they believe they could bother you. You could say, don't worry, we got this and we'll take care of it. Give it some time. You work at a plan with them. It's more touch. Yes, certainly, but it prevents issues. And that's just across the board in any type of property management. I think it's extremely important. You have to be a hospitality business. You cannot be in the, here, we gave you a four walls and have a good day type of thing.
Exactly. Well said. Spoken like a true expert in commercial real estate. Exactly right. I agree completely. Thank you for that. Now, I want to know your opinion about this Airbnb in New York City. They're cracking down on it. What do you think is going to happen over there? Is it just the beginning of other markets to follow?
I really don't know. And I don't think anybody should be cracking down on anything, to be very frank with you. I don't see how Airbnb hosts are violating the law. I just see, I see manipulation of the markets. I don't love it. I think Airbnb and the whole short-term rental concept has driven up the price of housing. I think that's unfortunate. But I think if you leave it to the cycles, people travel less. Right now, Airbnb across the country is seeing much higher vacancy rates. So quite frankly, I think we just got to let things do things. So I don't love it. I don't love regulation, but it's a very slippery slope, to be very frank with you. I mean, like, yeah, you don't love regulation. Okay, to what extent? And I don't know the answer to that question, to what extent I don't love regulation, because you need some regulation, right? You can't kill somebody. Okay, great. That's the highest level. Now let's go to the next step. Like, where do you stop? Right? And why do you stop? Is it because somebody who owns a huge chemical company and backs a political party doesn't want pollution? Does that mean pollution is good? No. So where do you draw the line? And I'm just not an expert on that, but I just don't like when they, stop me from making money. Because at the end of the day, I didn't come into money. Everything I have, I did through my hard work and people helping me, to be very frank. So I don't like when people pull up the ladder after themselves. So, oh, we're good. We're gonna put regulations in place that you won't be able to expand. You won't be able to find ways to make money. That's great. Okay. I understand your desire, but let the market speak to me. It's very simple. If you don't like the team, don't show up and buy the tickets. That's how I look at it. So, but it's oversimplified. So I really, it's just I have conflicting thoughts on it. But I could say for the longest time you couldn't convert hotels into multifamily because the unions didn't want to take hotel rooms offline in New York. And why am I beholden to the unions? I don't know. But they're the voters. City council decided that. They put it under peer review. I don't know what the status of it is right now, to be honest with you. I haven't focused on it, but these regulations often serve to stifle innovation, to stifle people that want to make a living, stifle people that want to actually become wealthy, expand the wealth, or whatever it is. I believe everyone should have their own risks. But does that mean that I should risk walking down the street with people walking around with guns like the Wild West? Probably not. So it's really, really hard to blend that. It's really, really hard to figure it out. So yeah. I wish I had a better answer. I don't.
Thank you so much for your insights on that. And makes a lot of sense there. I agree with that regulation and the drawbacks there. I remember not too long ago, Bloomberg implemented that no large sodas. Do you remember that one? You couldn't have that large soda. So
You
New
didn't
York
bring
City.
you didn't bring up my paper straw tweets.
Oh, that one. Oh, paper straw. I remember that one as well. And I remember going
Yeah.
in there, and my kids always complained that their straw would get so damp and it would always crush on them. They're like, why are these straws like this? I'm like, they're paper straws. But yeah, it's a lot of regulation. What can you do, right?
Yeah. Yeah. 100%.
It's New York
I
City.
don't know. Yeah. Well,
Commercial.
it's all over the place.
Yeah, exactly. Commercial mortgage-backed securities. This is a specialty for you. And a lot of people are afraid of them right now. There's a lot of fear in the markets. And of course, when there's fear, I think that those challenges bring opportunities. So tell us a little bit about what you're seeing in that space and what you're up to, whatever you can share, please.
So what I would say is if you want to take a commercial mortgage-backed securities loan, don't take it unless you have in-house counsel and a very, very strong property management team that you can really figure it out. I'm not talking about like if you're a top 50% owner. I'm talking about if you're top 10% owner. Otherwise, it's not worth taking in the current environment. It's way too difficult to work through it. The services are difficult to work with. It's structured. You end up getting more proceeds, but in long term, it's not a great situation. However, commercial mortgage-backed securities is a fractional interest way for investors to invest in loans in commercial real estate, and they therefore can have the benefit of that revenue, the benefit of the yield of certain bonds. And there's, as a borrower, there could be challenges as a result because you're not dealing with the direct lender. As a lender, as a bondholder, there could be challenges if your servicer is not having a really great understanding of the property, it's underlying it, or not having a relationship with the tenant. And then finally, you could structure all you want around risk. Sometimes the structuring is just not sufficient. So I think commercial mortgage-backed securities, especially given the bonds, are really looked at very differently than actual property and loans. And that's where there's opportunity for us, where we make investments, is to buy from people in the bond market that don't understand the real estate side of it and able to make a really a better bet than otherwise people would be able to make in the commercial real estate markets.
Exciting. Very exciting. I know you deal with the restructuring of that debt. Could you just give us a simple example so people can understand what exactly you do as an advisor to these borrowers when you're restructuring a debt? What is your goal and what is the key there in that process?
So when we started off, you asked me what is distress, and I said one instance of distress is when a borrower doesn't, when a borrower doesn't have enough cash flow coming from the property to make his mortgage payment. If that happens, then what I do is try to work between the borrower and the lender to try to get the lender to give the borrower concessions, grant the borrower concessions so that they're able to retain ownership of the asset despite not being able to make their full mortgage payment in some form. It could be a forgiveness of some mortgage payments. It could be a forgiveness of principal. It could be a change in the terms. So these are things that I do, but the way I do it is to understand how the special servicer, how the trust, how the lender is constructed internally and what their requirements are and what's acceptable to them. And also to be able to paint the picture and explain to them what's happening with the property. Because the one thing that you can change, you could change the owner, you could change the value, you could change what the value of the debt, whatever you want, but you can't change the property. The property is always going to be the property. And I work to explain that to both parties. I work to get the borrower to give the lender its best possible offer, and the lender works very hard to get me to make sure that I get the borrower's best possible offer. Then I work to get the lender to work with the borrower and to the greatest extent possible.
Love that. Wow. This has been amazing, Shlomo. This has truly been an honor for me. You are so amazing in commercial real estate. You have the vast knowledge and experience. Thank you so much. What are some wise words you could tell our audience about commercial real estate during these times? This is about September 2023.
Oh my gosh. Here's the wise words. I don't know what happens next.
I love it.
I'm making bets on a property by property basis. I don't make bets on a big market basis other than to ask myself how it's going to affect those properties individually, and what if it doesn't, what happens next. That's really how I go about this. So yeah, that's I think the smartest thing I could possibly say is that I don't know. I wish I did, but I make bets based on data on a local property individual basis, not on the general market for the most part. And I think that's, if someone asks you how the property market's doing, how real estate's doing, you could answer any way you want, but you don't know, and I don't know.
I love that. Those truly are wise words, because no one knows. And, there's a difference between the micro and the macro. It's the same thing of asking, an investment advisor, how's the market? What's your thoughts on the market? It's like, well, there's different parts of the market, like right now they're saying there's a bull market in commodities, while, other parts of the market, there's a potential bear market. There's so many different parts, so many sectors.
It just means a bunch of people got together and felt very risk on that day, and that's why it's a bull market. That's all it means. So if you want to be one of them, that's good. You want to take the position against them, you can take position against them. There's nothing really happening other than what we make happen, and you just got to read people, and you got to understand cycles, you got to understand what happened in the past, and go back to what we discussed before. It rhymes.
Love that. Wise words for sure. So Shlomo, tell our audience how they can follow you, and tell them about your website, Terra Strategies.
So you can follow me on all social media. It's at Shlomo Chopp, first name, last name, SHLOMOCHOPP. Website is terrastrategies.com. It's just basically informational website, talks a little bit about what we do. It doesn't really go into great detail. And happy to interact with anyone on social media. It's usually like at the end of a long day or the beginning of a day that I actually tweet, or between meetings I'll tweet something, not planned out in any way. So yeah, I love interacting with people and sort of learning from people and challenging them, right? If someone says something that I disagree with, I'm like, okay, explain to me. If I'm wrong, I'll accept it, no problem. Actually, I want to know if I'm wrong. I don't want to make bad bets. So
love it. Thinking in bets and thinking in probability as always. And we don't know the future. No crystal balls here. So thank you so much to you and to the audience.
Thank you.